It's actually kind of funny. You drive down the street, you grab a coffee, maybe you drop off an online return at a warehouse somewhere.
Right, just normal everyday stuff.
Yeah, exactly. And maybe you notice a sprawling new self-storage place going up on the corner, and it just feels like this passive backdrop of life, like it all just, sprouted out of the ground organically.
Yeah, people definitely think that.
But behind every single one of those brick and mortar buildings, there is a very specific high-stakes game of financial chess being played.
Oh, absolutely. It really is a game of invisible forces. The physical world around us, like where we eat, where we work, where we get our cars washed, it's entirely shaped by spreadsheets.
Spreadsheets and interest rates.
Exactly. Spreadsheets, interest rates, and investor strategies that most people walking by will never actually see.
And that is our mission for this deep dive today. We are pulling back the curtain on the commercial real estate market, but we aren't doing it by reading some dusty textbook on economic theory.
No, definitely not.
We've actually got our hands on the literal catalog of what investors are buying and selling right now.
Which is incredibly revealing, honestly. I mean, it's one thing to talk about the economy in the abstract, but it's another entirely to see the exact price tag and the hidden strategy behind a strip mall in Texas.
Yeah, so we are looking at a highly curated investor newsletter. This is the April 11, 2026 edition of the EBG listings of the week. It's put together by the Eureka Business Group, that's EBG, and compiled by their managing principal, Joseph Goslin.
Right.
And it's basically a snapshot of commercial real estate opportunities in Texas and Oklahoma. And, why should you care about this? Because the math in this exact newsletter dictates the physical landscape of your neighborhood.
It really does. It dictates what businesses can survive there, what gets torn down, and what gets built from scratch.
Okay, let's unpack this, because to understand the individual buildings, we sort of have to start with the broader economic weather report. The newsletter opens with an observation about the macro environment. They mention that despite various world events, the market is just pushing through with increased leasing and sales activity. But the detail that really got my attention was about the Federal Reserve.
Ah, yes. The interest rate tease.
Yeah. Analysts aren't expecting a rate drop this exact month, but there's a prediction in here for the next meeting that seems unusually high.
You're talking about the FedWatch tool prediction.
Yes, exactly.
Yeah, they're tracking a 95% chance of a rate cut at the next meeting. And, I mean, in the financial world, a 95% probability is essentially a guarantee.
Wow.
But the crucial part of Goslin's commentary here is that banks are already pricing this expected cut into their current loans.
I want to understand the mechanics of that, actually. Why would a bank offer a lower rate today for something that hasn't officially happened yet?
Well, think about, is it like a grocery store knowing the wholesale price of milk is going to drop next week, so they can afford to lower the price on the shelf today to beat out the competition because they know their replacement costs will be cheaper?
That is the perfect analogy. Banks are essentially in the business of managing risk and capturing deal flow.
Right.
So if a rate cut is a near certainty, their own future borrowing costs are going to drop. If they wait for the official announcement to drop their rates,
their competitors will have already snatched up the clients.
Exactly. So they offered the lower rate today to win the business. And the newsletter gives a concrete example of this. One of EBG's clients just secured a term sheet for a single-tenant retail asset at a 5.75% interest rate with a 30-year amortization.
Wait, hold on. A 30-year amortization. I always thought commercial real estate loans were much shorter than residential mortgages, like maybe 5 or 10-year terms. Am I misunderstanding how that works?
You're actually touching on a really vital distinction in commercial finance. It's the difference between the loan's term and its amortization.
You are totally correct that commercial loans usually have a short term, meaning the full balance of the loan comes due, or balloons, in 5 or 10 years.
Right, the balloon payment.
Exactly. But the amortization is the schedule used to calculate the monthly payments. If a bank forces you to actually pay off a commercial building in 5 years, your monthly payments would be astronomically high.
Oh, the business would choke on that cash flow.
Completely. So they stretch the math out over 30 years to make the monthly payment tiny, even though you have to refinance or pay off the massive remaining chunk in year 5.
Ah, okay. So a 30-year amortization at 5.75% means the investor's monthly cash flow is going to be incredibly healthy right out of the gate.
Precisely. It gives them breathing room. And that forward-looking momentum, banks getting aggressive with good terms, it brings us to the actual vibe on the ground.
Right. The newsletter talks about market momentum, but Do they have actual data to back that up, or is it just a feeling from the brokers?
Oh, they track this meticulously. EBG has their own proprietary retail velocity index for the Dallas-Fort Worth market.
Okay.
For March 2026, it's sitting at 5.9 out of 10.0, which is a slight uptick from the previous month. But the commentary accompanying that number is what really matters. They describe the Dallas-Fort Worth retail market as operating in a two-speed environment.
A two-speed environment, meaning the market is splitting into two different realities.
Yes, exactly. On one speed, you have premium assets, brand new construction, perfect locations, corporate tenants. Those are flying off the shelf.
And the other speed.
The other speed involves older inventory. For these older, maybe slightly tired properties, leasing is actually accelerating too, but it's driven by what they call value-driven leasing.
So tenants hunting for bargains and landlords having to get creative.
Exactly. This bifurcation is kind of the defining characteristic of the current cycle.
Well, that perfectly sets up the actual properties on this list. Let's start with that scrappier, value-driven side.
Let's do it.
We have a property in Dallas. It's a 3,650 square foot car wash with a 20-plus year operating history. It offers immediate cash flow. But they are asking nearly $2 million for it. And it sits on less than an acre, 0.84 acres to be exact. I look at that and think, wait, almost $2 million for a tiny car wash on less than an acre? I mean, that seems insanely overpriced just to wash cars. What am I missing here?
Well, you are missing the dirt. Or rather, the potential of the dirt.
The dirt.
Yeah. If we look closely at the listing, the key bullet point isn't the soap dispensers, It's the phrase redevelopment upside.
Oh.
This is what the commercial real estate industry calls a covered land play.
A covered land play. Okay, walk me through how an investor views that.
Dallas is booming. Land on high-visibility corridors is incredibly scarce and valuable.
Right.
An investor wants to buy that corner to eventually bulldoze it and build, say, a 5-story apartment complex or a massive retail center. But getting permits, finalizing architectural plans, and securing construction loans, that can all take 2 or 3 years.
And if you just buy an empty dirt lot, you are bleeding money every month, paying property taxes and insurance while you wait for the city to approve your paperwork.
That's the trap of raw land.
Ah.
But with a covered land play, you buy an existing functioning business, in this case, the car wash. The income from washing cars isn't the main prize, but it covers your property taxes, your insurance, and your mortgage. It literally pays you to hold the land until you are ready to send in the bulldozers.
That is brilliant.
Yeah.
You're buying the future, but the present is paying the holding costs.
Exactly.
And speaking of the land itself, there's another property here that highlights a totally different kind of operational freedom. It's an industrial flex property in Roanoke, Texas.
Oh, yeah, this one.
Flexible multi-building layout, fenced yard, strong highway access at I-35 and US 377. But the ultimate selling point, complete with an exclamation mark in the newsletter, is outside city limits. No zoning restrictions.
Yes.
Why is no zoning such a coveted feature?
Because city zoning can be a suffocating web of red tape, particularly for heavy commercial or industrial users. Imagine you run a landscaping business, an equipment rental company, or a heavy vehicle repair shop.
Okay, messy businesses.
Very messy. If you operate inside city limits, the zoning board might tell you that your trucks cannot be visible from the street.
Right.
They might prohibit outdoor storage of raw materials. They might enforce noise ordinances that prevent you from running machinery past 5:00 p.m. or on weekends. They dictate how many parking spots you need, what kind of trees you have to plant, and even what color you can paint the building.
Which means you spend half your time fighting with city inspectors instead of actually running your business.
Precisely. But outside city limits, with no zoning restrictions, you can use that fenced yard however you need to. You can park 20 heavy trucks without worrying about a residential noise complaint. You can stack shipping containers.
Wow.
It offers an operational freedom that certain business owners will pay a huge premium for simply because it removes the city as an obstacle to their growth.
Which totally explains why EBG highlights it as an exclusive listing. Now, what about the properties that aren't quite so perfectly positioned? We have a medical office in McKinney, Texas. It's 2,900 square feet. But the mind-blowing part is that it is selling below the county assessed value, and the seller is offering owner financing.
This is the epitome of the value-driven side of the market we talked about earlier. When a commercial property is listed below its tax-assessed value, it usually signals severe seller motivation.
Like what kind of motivation?
They might be retiring, Or perhaps they just don't have the capital required to update the building to compete with all the newer medical spaces popping up.
But what is the mechanism behind owner financing? Why wouldn't the buyer just go to a bank?
Well, traditional banks are very cautious about properties that need a lot of work or have high vacancy.
Ah, right.
By offering owner financing, the seller essentially acts as the bank. The buyer gives the seller a down payment and then makes monthly mortgage payments directly to the seller instead of a traditional lender.
Okay, so it cuts out the middleman.
Exactly. It bypasses the friction of bank appraisals and rigid underwriting. It's a tool used to force a deal through when traditional financing would probably kill it.
So the under 2 million space is full of scrappy, hands-on work. You're dealing with bulldozers, zoning loopholes, and creative financing.
Yes, very active investing.
But what happens when an investor has, say, $5 million to place, and they absolutely do not want to roll up their sleeves? How do you buy passive income?
That is when you move into the premium speed of the market. This is where you trade the operational heavy lifting for structured, predictable cash flow backed by corporate guarantees.
Predictable cash flow. Because as I read through these mid-market listings, the $2 to $10 million range, I keep seeing the phrase absolute NNN ground lease. What is the actual mechanism there? I know NNN stands for triple net, but how does it work in practice? Is it basically the holy grail for a lazy landlord?
It kind of is. The three nets in commercial real estate stand for property taxes, building insurance, and maintenance. In a standard lease, the landlord might cover the roof and the structure, while the tenant covers the interior. But in an absolute triple net lease, the tenant is 100% responsible for all of it.
So if the HVAC system explodes or the property taxes double, the landlord doesn't pay a dime. Like you just sit on a beach while they pay for everything.
Not a single dime. You sit on the beach, and the rent check you receive is purely profit, free and clear of any operational expenses.
Wow. Let's apply that to a real listing here. There's a retail space in Harker Heights, Texas. Brand new 2024 construction. The tenant is a corporate Starbucks. It has 9 years left on the lease, and it sits in a high-traffic area over 29,000 vehicles a day.
That is the textbook definition of a premium asset. You aren't really buying a building.
You aren't.
No, you are buying the corporate guarantee of a multi-billion-dollar coffee empire. If the roof leaks, Starbucks dispatches their own contractors to fix it. Your risk profile as an investor is incredibly low.
It's essentially like buying a corporate bond that just happens to be shaped like a drive-through window.
That's exactly the logic. And because it's so safe and passive, investors will accept a much lower yield on their money to own it.
Now, there is another structure in this passive tier that threw me for a loop. A single-tenant retail space in Richardson, Texas. Great location, huge population density, like 350,000 people within 5 miles.
Yep.
Based on the photo, the current occupant is Noble Fine Jewelry. But the listing specifically calls out a sale-leaseback structure. Let me make sure I understand this conceptually.
Sure.
Is a sale-leaseback like me selling my house to pay off debt, but insisting that the new buyer let me stay living there as a renter?
Mechanically, yes, that is exactly how it works.
Why would a successful jewelry store sell their own building just to pay rent to someone else? That feels backwards to me.
It really comes down to a concept we call trapped capital. Think about the business model of a jewelry store. Their expertise, their profit engine, is acquiring and selling diamonds, watches, and precious metals.
So they sell jewelry.
Exactly. It is not owning real estate. If that business owner owns their building free and clear, they might have $3 million tied up in bricks and mortar.
Right. The money is literally trapped in the walls.
Yes. By executing a sale-leaseback, the jewelry store sells the building to an investor, instantly cashing out that $3 million. Simultaneously, at the closing table, they sign a 15-year absolute triple net lease with the new owner.
Oh, I see.
The jewelry store doesn't have to move. Their customers see absolutely no disruption. But the business owner now has $3 million in liquid cash to open new locations, buy a massive amount of inventory, or acquire a competitor.
Oh, wow. They trade a dead asset for working capital. And for the investor buying it, they get a building with a guaranteed, proven tenant already baked in from day one.
It's a very elegant solution. It solves a capital problem for the business and a deployment problem for the investor.
Okay, here is where it gets really interesting. What happens when the zeros increase? Let's move into the institutional scale, the heavyweight properties in this newsletter. We are talking $10 million and up.
The heavyweights.
Yeah. There is a massive 137,480 square foot industrial site in Corpus Christi. And the tenant is an investment-grade anchor Amazon.
Right.
It mentions a recent 5-year lease extension, but there's a bullet point here. $16 million plus tenant investment. $16 million. But honestly, if Amazon is paying for those upgrades, why does the buyer of the building care? It's not their money being spent.
Oh, the buyer cares deeply because of a concept called stickiness.
Stickiness.
Yeah. In commercial real estate, vacancy is the ultimate wealth destroyer. When a tenant leaves, the income stops, but the mortgage and taxes continue. Plus, you have to pay broker commissions and renovation costs to secure a new tenant.
It's a massive financial hit.
Now imagine Amazon moves into a generic warehouse. If it's just an empty concrete box, it's very easy for them to leave when the lease expires and find another empty box down the road.
Right, they just pack up the trucks.
But this listing tells us Amazon has sunk $16 million of their own money into customizing this specific building. They've installed specialized conveyor belts, automated sorting robotics, structural climate control.
Ah, I see. They've rooted themselves into the foundation.
Exactly. A tenant who spends $16 million customizing a facility is incredibly sticky. They are not going to leave over a minor rent increase because walking away means abandoning that massive infrastructure investment.
Wow.
For the buyer, that bullet point is a flashing neon sign that says this tenant is never leaving and your cash flow is secure.
That makes total sense. It's like financial gravity. Now, contrast that extreme safety with another heavyweight property here, a 60,140 square foot retail center in Odessa, Texas.
Ah, the Odessa property.
Yeah, it's anchored by a corporate TrueFit athletic club. But the numbers here are completely different. It's offered at an 8.95% cap rate, and it has 17.5% vacancy. First, let's establish a baseline for everyone. What actually is a cap rate mechanically?
Sure. A cap rate, or capitalization rate, is the primary metric used to value commercial real estate. It is simply the property's net operating income, the profit it makes in a year, divided by the purchase price.
Okay.
So if a building generates $100,000 a year in profit, and you buy it for $1 million, that is a 10% cap rate.
So a higher cap rate means a higher return on your money, which sounds great.
Hmm.
But it also usually implies higher risk, right?
Correct. The ultra-safe Starbucks we discussed earlier might trade at a 5% cap rate. Investors pay top dollar for safety. This Odessa property is trading at an 8.95% cap rate because that 17.5% vacancy represents risk. Empty storefronts don't produce income.
So to me, empty stores sound like a problem to run away from. Why would institutional money want a half-empty strip mall?
Because to a savvy operator, vacancy isn't a problem, it's the raw material for forced appreciation. This goes back to our two-speed market idea. This property has lease-up upside.
Lease-up upside.
Yeah, this is where commercial real estate creates immense wealth. The 8.95% cap rate reflects the current risky reality. But the buyer isn't buying the current reality, they are buying the math of the upside.
Walk me through that math. How does filling the vacancy force the value up?
Let's look at the anchor tenant. You have a massive TrueFit gym bringing hundreds of people to the parking lot every single day. That's a built-in customer base.
Right.
The 17.5% of the center that is vacant is currently producing $0. If an investor buys this center, brings in a good leasing team, and fills those empty spots, maybe with a smoothie shop, a physical therapist, and a supplement store that feed off the gym traffic, they increase the net operating income.
And because the value of the building is literally a multiple of the net operating income.
Yes. If you increase the property's profit by, say, $100,000 a year, and the market values properties at an 8% cap rate, you haven't just earned an extra $100,000 in rent. You have forced the overall value of the building to increase by $1.25 million.
That is staggering. You don't wait for the market to appreciate. You force it to appreciate by fixing the income stream.
Exactly. You buy the problem, fix the problem, and harvest the margin.
Unbelievable. Let's touch on one final property that operates on pure efficiency. An 84,452 square foot self-storage facility in Little Elm, Texas.
Passive giant.
Built in 2022, 100% leased, generating over $543,000 in-place net operating income. And it sits in the high-growth US 380 corridor. Over $500,000 a year in net income from people storing their extra couches and seasonal decorations. Why is storage such a prized asset class?
Because it is famously one of the most cash flow efficient real estate models in existence. Think about the overhead. You don't have to deal with leaky plumbing in 100 different apartment bathrooms.
Right.
You don't have a restaurant tenant whose commercial kitchen might catch fire.
It's just concrete, metal, and padlocks.
Concrete walls, roll-up metal doors, and highly automated billing systems. In a rapidly growing area like the US 380 corridor, where thousands of new houses are constantly being built, the demand for transition storage is endless. It produces incredible margin because the operational friction is practically zero.
It is the ultimate low-maintenance cash machine. Well, we have covered a vast landscape today. We started with a macroeconomic whisper, a 95% chance of a Federal Reserve rate cut.
We did.
And we explored how that invisible high-level number trickles all the way down into the concrete and steel of our neighborhoods. We saw how it drives the math of bulldozing a Dallas car wash, how it creates the safety of a Harker Heights drive-through, all the way up to the institutional gravity of an Amazon warehouse.
Every single one of these listings represents a unique bet on human behavior, local zoning laws, and the relentless efficiency of capital.
So my hope for you listening to this is that the next time you are sitting in a red light and you look over at a strip mall, a standalone medical clinic, or the massive fulfillment center on the edge of town, you realize you aren't just looking at architecture.
Right.
You are looking at highly calculated investment strategies playing out in real time right in front of you.
I'll leave you with a final thought to ponder. As the way we live continues to evolve, as e-commerce reshapes how we buy things, and as the market splits further between ultra-premium corporate centers and flexible, unzoned industrial yards, how much of your city's physical layout is actually decided by local community planners, and how much of it is quietly, invisibly dictated by the math of an 8% cap rate and the stipulations of an absolute NNN lease?
A fascinating question to chew on. Thank you so much for joining us on this deep dive into the EBG newsletter. Keep your eyes open because the commercial landscape is shifting right in your own backyard. We'll catch you next time.